And I'm back finally. You guys, it's been a really busy end of Q4 of 2024 last year. So I was, busy doing real life stuff with the business behind the scenes, end of year reviews, tax stuff, RMDs. Essentially, I know I need to do some more content though. So here we go. And it's already March. It's my birthday month. But, anyways, Q1's also kind of busy too. Again, with tax filing, New Year stuff, goals, just reviews with all my people, etc. So but new content coming here shortly. I'm going to load up on a bunch for you so I can get back to that consistent schedule, of course, with posting. So today, going over real quick, $1 million portfolio example. I'm going to break that down how I allocate that here at my firm. So how I would do that for clients, existing clients, whether that's myself or current ones. Now, again, not giving away any exact client information here, and I'm definitely can't give you any specific positions, such as which exact ETFs or stocks, but I'm going to give you some a general idea and guidance, of course. If you want those exact positions and you want that specific advice, there has to be disclosures that get out to you and client agreement, et cetera. So a lot of regulatory stuff that we have to get out your way. So that's why, again, in a broad sense, this is what it looks like. But $1 million portfolio. And what we're looking at here is how we're going to split that up and allocate you. Now, once it's there and implemented, you're going to go into a monitoring stage really for the most part, because if it's working, you're not going to try and fix what's not broken. Obviously, there could be some minor adjustments to this over time based on economic conditions. But what we're going to start with, and usually with people here, with that amount too, what I'm going to tell them first is we're going to talk to a little bit of the behavioral side of money, and then a little bit of the peace of mind, and of course their own goals for themselves or their estate. But first off, I want to address is how much cash makes you feel safe, and that's the priority question I usually ask them, and everyone has their number essentially. Now they may have this cash that I'm referencing in the bank already. They may also want to keep it in the account, and I run into that both ways. Sometimes it's a little bit of a mix of both worlds, really. Now, personally, I prefer if it wasn't in the bank so much, it was actually in your accounts, because that way I can report that data to you fully. I can manage it all, the whole thing better for you, and ultimately do a better job for you. And typically, the cash in your investment accounts, whether it's Fidelity or Schwab, but most particularly Fidelity, it's going to pay a higher interest, obviously, than what it's making in your bank probably, and we don't have to lock it up in the form of CDs or anything too. It's just as accessible as money in the bank as well. Okay, so rough numbers here on this is I usually tell people, what do we need to live on per year now that you're retired, or you're getting close to retirement, or we've kind of achieved this $1 million portfolio level. And typically at this point, the consumer debts are gone. They're wiped. There's no vehicles. There's no car notes. There's no the mortgage is usually either done or getting close to being done. Kids are out of the house, so you're empty nesters, and you master a lot of that spending behavior. If you're able to accrue $1 million in your retirement investment accounts, you kind of mastered that month to month, if you will, of your account. Now, let's say all else fails. Cash is cash. It's still cash, no matter where it's held, bank, Fidelity, etc. It's not going to move and fluctuate with the markets, obviously, like so with what your portfolio is doing. The investments, it's not going to really move much with what's going on in the world, outside of that little invisible enemy called inflation. That's going to obviously eat into its purchasing power. But outside of inflation, cash is cash. Gives you peace of mind, helps you stay invested. That's probably the most important reason. Having enough of it on hand, essentially. So about 3 years, maybe two, if you're a little more aggressive, or if you have fixed income or employment income coming in still. You want to keep about 2 to 3 years of cash that you need in your accounts or in your bank account, or a combination of both. Excuse me. Getting over a little cold too. I picked up recently from one of my clients. Who was it? I'm gonna get you. um, so the point of having 3 years of cash essentially in your accounts, or in totality, and that may be, just to put a number to it, let's just say 50 grand. That's $4,000 a month, basically. That cash is not going to fluctuate with the markets no matter what's going on or what news is being reported, or who's elected now, etc. That's going to stay flat for you, basically. It's going to make a little bit of interest along the way. So let's just say it's all in a portfolio that I manage for you. I'm going to have about 150K of your $1 million. That's 3 years of what you need in cash, 50K a year, to give you peace of mind and help you get through any turbulence, in the portfolio, in the world. That's typically enough to get through, most traditional bear markets in your accounts, or deep recessions are going to run that period anyways. So and they're going to recover and go up and up and up. That's why you don't want to time things. You want to keep the bulk of your assets invested still, collecting dividends and interest, and then on the upside, it's going to catch it all. And then, excuse me again, you're not trying to time the market either, of course, there. So 1 million, 150K in cash that we know that's going to get us through 3 years. If the portfolio is $1 million and then, oh my God, we lose, we're down 20% or so for the year. And now we're at 800K. Well, guess what? 150 of that is still the 150 in cash that was not exposed to any of the volatility going on with equities or treasuries, essentially. That means your lifestyle, if we're tapping into that, we're now, we're taking money out of your accounts essentially to live on. That means your lifestyle stays the same, and you can go on your walk every day. You can go get your coffee. You can go travel and do your trips. You can pretty much do whatever you want to do, essentially the same as usual, knowing that you have 3 years of cash within your accounts to touch if you need. That lets you stay invested. That lets you maintain the same quality of life as you have today. And again, hopefully gives you a little more peace of mind, right? So that's why I personally like 2 to 3 years of cash in my retirees clients accounts. Not necessarily if you're still growing and accumulating, but if you're living on the portfolio, when you trigger that and it's time, want to keep about 3 years of cash in there essentially. All right, next, of that $1 million, I'm going to allocate about 400,000 of it to large cap. Again, I use an all ETF model in my accounts. They're more tax efficient for for many means. They're more time efficient for a lot of means too as well. They're a wonderful tool to use versus individual equities. So we're gonna have about 400K of large cap. You can think of large cap as the top 500 companies essentially. So let's call it the S&P 500 again, without naming a specific ETF. I'm going to have about 400K of it exposed to. Sorry guys, I was really dry throat all of a sudden. 400K exposed to the large cap movements, which we know will probably get the most growth there. And there's a lot of diversification within that large cap. So just in the S&P 500, for example, about 35 to 40% of those companies, which are technically US companies, about 35 to 40% of that actually have international exposure as well too. So I'm personally not going to have any international positions in your portfolio because the S&P 500 already has a significant amount of their revenues derived outside of the US. So to me, we actually have a lot of exposure already within an S&P 500 holding within your account. And again, that's going to get us the most growth over time. The current dividend yield on that's around 1.5 or so last I checked. So you pick up a decent dividend along the way, and then you're going to get most of your growth over time too as well. Because if you're retiring with $1 million now, you want it to still grow. You don't want to just have it all in cash, earning whatever money market's earning, which changes. You want to have some invested so that you beat inflation, you stay ahead, you have enough money for yourself and for your heirs essentially too. Okay, next we're gonna have about 200,000 of that 1 million in more dividend focused positions here. I want to pick up dividends of somewhere around 3 to 4% a year with that, roughly, and some growth as well too. These are going to be usually your blue chips, essentially, in the world, who have been established, who pay a healthy dividend, who have a strong business model, lots of free cash flow, etc. Now, we're still going to go for growth here too. Now we're going to position about 150K of your million into tech, essentially, and grow. This is where all the growth is happening for the most part. So we want to have that exposure over time. It's going to be more volatile, yes, up and down. It's probably going to pick us up more than the other positions over time, but it could also in shorter periods be down as well too. So more volatile, but we want to have it there for growth. And then I'm going to leave about 100K here. Free of that $1 million for discretionary sector rotation. So that could be consumer staples at some point. That could be defensive or utility, et cetera. That could just go into existing positions that I mentioned too as well. So I do want to leave about 100K or 10% of the portfolio kind of free to rebalance into the other sectors, based on what's going on in the world, essentially. But really, guys, once you have that portfolio set and implemented, less activity is more, to be honest, as far as your investment returns and your performance over time. And then your job, your position as an investor, to be a best investor, you really want to have this, implement it, monitor it. Sometimes taking no action is best, to be honest, when it comes to your own investment returns and your rate of success too with this stuff. Anyways, hope that helped. That's a $1 million portfolio. When you guys have that accrued, that amount, if you want to talk more, my name is Justin Hodges. I run my own firm. Virtually, we're based here in Hawaii with a couple team members too, but we help clients all over the country too. So more details in the notes below. And sorry again for the cough, and expect a few more contents coming out here shortly. Thanks, guys.